Let us first understand the definition and purpose of the pro forma financial statements. Pro forma per se means as a matter of form. It's a structure. We make certain statements, financial statements, as per the form of the financial statements. But they are not the actual financial statements. They are like draft financial statements. They are projected financial statements. They are forecasted financial statements. Clear? So these financial statements, the pro forma financial statements, they are made on a what if basis. What if the sales were to grow by 10%? What if the cost of goods sold is going to change or increase by another 5%? What if the sales is not going to grow, instead there is going to be a fall in the sales by say 5%? So pro forma financial statements are kind of draft financial statements, are financial statements which are made on the basis of certain assumptions and on the basis of certain forecasts that we make. They are not the real statements, but they help us to plan. We try to consider different situations, different assumptions, and based on that we make financial statements. These pro forma financial statements may be prepared for a year or for 2 years or 3 years or for 5 years. Right? We could prepare long term or shorter term pro forma financial statements. And mind you, these financial statements are prepared for the company as a whole, not department wise. The entire the profits of the net income of the entire company, entire organization, the assets and liabilities and equity, that is the balance sheet of the entire organization. Of course, we can also prepare the cash flow statement. Those are the pro forma financial statements which are prepared based on certain assumptions and forecasts. What is the purpose, students, of pro forma financial statements? A pro forma financial statements, you must understand, is a part of the planning process. They are financial statements which are prepared for internal use. If you remember, we mentioned before that financial statements are a general purpose statement which is studied and discussed and which is studied, analyzed, poured over by all people, many kinds of people. It's available to the public, by the shareholders, by the prospective investors, by the lenders, by the suppliers, by the customers, by the management themselves, by the employees, and so on and so forth. But when we are making pro forma financial statements, you must understand that it is a part of the internal it's a part of the internal planning process. Okay. What else can it do? It can help to ascertain the cash position. The financial statements also, pro forma financial statements also help us to understand the cash position. Do we need more cash? Is there extra cash? Do we have to arrange for overdraft? Do we need additional financing? Or do we have excess cash we can repay loans? What is are there interest payments? And so on and so forth. So once pro forma financial statements are made, these decisions can also be taken. Once pro forma financial statements have been made, they must be checked with the strategic objectives. They must be checked with the strategic objectives to ensure what? That they are in compliance with the strategic objectives. And what do you mean by strategic objectives, students? When we say strategic objectives, these strategic objectives are normally represented in ratios. Have we achieved the target of the return on investment that we want, the return that the shareholders want, the return on equity? How profitable are we? Are the targets of net profit being achieved? Is there liquidity? Are we in a position, after preparing the pro forma financial statements, does it look as if we are in a position to meet our short-term obligations? What about the solvency ratios? That is long term. Are we in a position to meet our long term obligations? Are the solvency ratios satisfied? So these strategic objectives are actually represented by ratios, and once the financial statements are made, we compare, we compute the ratios and see whether they are in line with the strategic objectives and strategic ratios, target ratios which have been laid down by the management, right? So that is one thing it does. Next, what else does it do? The forecast, the projected financial statements are made on the basis of certain assumptions, and what happens in case any of these assumptions change? Estimate the effects of changes in the key assumptions, right? This is actually called sensitivity analysis. So though we have expected the sales to grow at 10%, suppose it were to grow at only 5%, or suppose it were to fall by 2%, what then? What happens? What is the effect? What is the effect on all these factors? What is the effect on the profitability, on the liquidity, and so on and so forth? That is called sensitivity analysis. So that also can be made. After all, these are forecasts, these are assumptions. We need to check what would be the effect if these assumptions are slightly different from what we expect them to be. Would the impact be severe? How severe or how great would be the impact, and what action we should take? We should be prepared. It also helps to determine the dividend policy. Once we know what the pro forma statements look like, we can then make, when we pay more dividends, should we in fact not pay out, have a lower payout ratio, give lower dividends. All this we could decide, the management could decide once the pro forma draft financial statements are prepared, that the dividend should increase, decrease, or retain the same rate of dividend. Followed. So what are the planning functions that the financial statements are supporting? First, it helps to assess whether the anticipated performance is in line with the established targets. There are established targets. What did we say? These are with ratios, in line with the ratios, right? Anticipate, so that's one, where the strategic objectives are being met. Next, what is the amount of funding which may be needed to achieve the forecasted sales growth? Do we need funding, or are we, on the other hand, in a position to repay our funds? What could be the dividend policy based on making of the pro forma thing? So it's not just the amount of funding, the repayment, the dividend policy, all this, it helps us to plan, supports this planning function. And also it estimates the effects of changes in assumption of key numbers. So what happens if the cost of goods sold changes, the sales growth is different than the number that we have assumed it to be? So what does it do? This is how the planning functions are supported, because one, they check whether the performance, what we expect the performance to be, will be in line with the targets. Then we check the amount of funding, or the amount of repayment, or the dividend policy. These things can actually be decided by the management based on the pro forma functions, right? Based on the pro forma financial statements. That's right, students. And also next, this is called sensitivity analysis. It helps the management to see what is the effect of the changes when some assumptions change. So what is the purpose? From the income statement, we see whether the net targets are being met, net income targets are being met, whether there is sufficient profit to cover the interest payments that have to be made, As far as the balance sheet is concerned, we see whether the short-term liquidity position, the liquidity ratios are satisfied, whether long-term solvency ratios are satisfied, asset turnover ratios are satisfied. Similarly, when we look at make the pro forma cash flow statement, that tells us also whether the target cash flows from operating, investing and financing activities are met, and may help to frame the dividend policy depending on the availability of